Hi, I'm Lindsay Biscaya. Welcome to Market Call. Dan Rohinton is on the show today. He is Vice President and Portfolio Manager at IA Global Asset Management, and we'll be taking your questions on Canadian and global large caps. The number to call us is 1-855-326-6266, or you can send an email to marketcall@bnnbloomberg.ca. And Dan joins us in studio. It's great to have you in.
Good to see
Thanks
you.
for coming in. A Happy New Year as well.
Happy New Year to you too.
Okay, so second day of 2026, first day of trading. You say maybe for 2026 we might see a bit of a broadening out in the market, particularly when it comes to kind of mega cap stocks. What are you seeing that makes you think that?
Yeah, and I think it's important to take a step back. We've had 3 years of pretty strong markets as a whole. So, investors as a whole should take a step back and say, earning 15 to 20% per year is not the normal pace of things. Things should be a bit slower than they are. But that being said, normally speaking, when you have healthy markets, they tend to broaden out beyond the top handful of stocks. And to be fair, we haven't seen that day one today, but there's still 364 more days to go. And what I expect is that the AI beneficiaries should see more downstream of some of the capital that they're spending go into more industrial companies, more other technology companies, and being able to adopt those things should help uplift more stock prices than just NVIDIA and Avago and Microsoft.
Right, just a few select ones. So do you think then 2026, like just to go off what you said off the top there, you think it's going to be more quote unquote normal compared to what we've seen over the last couple of years, like more modest, just not as many highs and lows?
Right. You know what's funny? There's no such thing as really a true normal anymore because back in the day, normal was a good old-fashioned recession that now post 2008, 2009, there was credit cycles. So we basically careen from peak to valley and back and forth. So I think the new normal that we've been in for the last 15 years, I think we're more likely to see more of that. But that being said, what you do want in strong, robust markets that have durability to them is not every conversation starting and ending with NVIDIA.
Right.
And I think we'll see more of that this year.
Interesting. That'll be interesting to see. And you say stock selection matters this year for investors. Like we'll obviously get into your top picks later and some certain stocks that you like. But what does that mean like for people who are maybe looking to kind of reset as we head into 2026? How should they do that?
And I think the important part in that discussion, and there's so many ways, we'll take the full hour if we fully went into it, but start with updating your priors for the world we move into today. And what I mean by that is don't take the orthodoxy of Coca-Cola is the best company in the world because I've been drinking Coca-Cola for 10 years or 50 years for some people, so on and so forth. So you have to reset and draw a blank page and say, what are the facts on the ground in the world as we speak today? And say the past is the past. And that's what I think is important. And the reason I think that's important is when you look at what's going on, we're seeing technological evolution at a faster pace than we've ever seen before. So we're moving at a speed faster than the adoption of the internet. And we're moving at a speed faster than the globalization, that trend that was 2000 to 2015, 2020. So that's what I mean is blank page, new year, new perspective. That means focus on what the future of these companies look like, and that's critical.
Okay, we're going to take a quick break right now, but we will be back in a moment. Dan Rohinton will be answering your questions. So stay with us. More on that coming up right after the break. Welcome back to Market Call. Dan Rohinton joining us in studio today to answer your questions. And we're going to go straight to the phone lines. Rob is calling in from Calgary with a question. Hi, Rob.
Hi. Thanks for taking my call. Happy New Year. I'd like to hear Dan's opinion on HSBC. I've held the stock for a number of years, and it's had a fairly nice run lately. And I'm wondering if I should continue to hold or take my gains and reinvest in other European, Canadian, or perhaps American banks. And does Dan have a preferred bank or geography? Thanks again, and all the best in 2026 investing.
Thanks, Rob. You too. Thanks for the question. I mean, a good question, right? When it comes to banks, is there a good area that you like to stay in?
Yeah, I think so. It's an interesting question for Rob himself. I'll personalize the advice a little bit, and what I will tell you, Rob, is when you think about just different banks, think of it as tastes like chicken, tomato, different geographies, different banks, they tend to have the same situation going on. So is HSBC all that different from other banks like JP Morgan or Royal Bank in a global context? Not really. So the opportunity for you is really, do you crystallize those gains that you've had in HSBC and then redeploy it into something else? I'd say probably no need. In general, to Lindsay, your question, when it comes down to it, the geography that I do think is the most interesting as we go ahead, primarily on valuation, is the European banks. And the reason I think the European banks are more attractive, HSBC kind of falls halfway in that house because it's half trade finance, half Hong Kong. So it's not really that European anymore.
Right.
Europe has the cheapest banking valuations in the world. Do I love banks today? Not really. But do I think the best geography in the world for Europe is banks in Europe? I do.
Okay. Trevor is now calling in from Sierra Vista, Arizona, with a question. Hi there. What's your question?
Hi, thank you. Mr. Rohinton, my question is on Tencent Holdings. It's the Chinese sort of the gaming / WeChat company. They do most of their business in China. So do you think they are as exposed to the global sort of tariff issues? And also, what do you think of their business? Thank you.
Okay. Good questions there. What do you think?
Yeah. I think Tencent is what Facebook would love to be one day, but never quite got there. And the reason Tencent is important as a company is it is the super app for the Chinese consumer. And it basically, they have a gaming platform. They have WeChat and QQ, and they've also been moving into the AI sphere as well. I think Tencent's an interesting equity, but I think I'd take a step back and say, you have to make a China call as a whole. And what I mean by that is when you're talking about China, you have to decide, are you okay with that geopolitical, geostrategic, that type of economic approach that happens? So there was a very distinct period of time where, call it, I believe it was 2016, 2017, when Alibaba was going public with its finance arm, Ant Financial, for almost $100 billion. And then they pulled it because Jack Ma said a few things that were not kosher for the CCP. That meant that the valuation collapsed by 70%, and Jack Ma disappeared for a few months' time, if I recall correctly. So you have to sign up for that. Otherwise, Tencent is a great company, well managed, well structured, and they have every right to win in AI, and they own the Chinese consumer when it comes to their day-to-day flows and their conversations. But that's the geopolitical risk that comes with China.
It's hard when you're looking at a specific company or a stock and there's geopolitical risks involved, right? Even though we've seen some of those tensions eased a bit with China, when it comes to China and Canada, China and the US, you just don't know, right?
You don't know. And one thing just to add, if I may ramble, is what was the most striking part of that whole time when Alibaba and Ant and Jack Ma were going through those things, Tencent had to do a one-time donation to some charities all of a sudden, and then all the other big tech did as well. So it was effectively a gratuity that they suddenly had to pay. So how do you forecast that?
Yeah.
I don't know, but that's what you have to do in China.
Good to keep that in mind. Okay, Terry is now calling in with a question. Terry's calling in from Edmonton. Hi there.
Hi. Good day. Yeah, my question's on Emera. Like everybody else, I'm looking for a high dividend stock for my TFSA. And has Emera run its course, or would you hang on to it? Thank you very much, sir.
Yeah, absolutely. First of all, so when you think about what's going on with Emera, it's more delevered than it was in the past. That's historically been the problem with Emera as a company, is they run a bit hotter than the Hydro Ones and the Fortises of the world. I do think it's an interesting equity, but as a higher beta Canadian utility exposure. I think that's a lot of ifs, buts, and whens. So I would take a step back and say, is Emera the best utility diversified for you? I'd say probably not. There's companies like NextEra Energy that have similar footprints that are in the United States. There's companies like CMS Energy. There's DTE. There's so many of these other utilities that offer compelling growth. So if you can step out of the Canadian and Toronto Stock Exchange lens and you're okay with diversifying into the States, just like where Emera's assets and its highest growth footprints are, I'd say maybe look at a NextEra or look at a CMS Energy as an alternative for that. You'll get most of what you get with Emera, but with a little bit less debt to boot, which I think is a good thing.
Emera has the yield of 4.3%. Terry said he's looking for a high dividend. Is that something that you think is important?
It is and it isn't. And the reason it's not the most important thing is the way you get to high dividend yields is with very high payout ratios. And that's actually been a risk at times for Emera, is the risk of a dividend cut. So we want to be careful. So I would much rather take a far safer 3%, 3.5% yield than 4% that's a little bit tight. I don't think that's a worry right now, but I think that's just been something it's worth saying in the past for Emera that's been an issue.
Something to keep in mind. Okay, Ray is now calling in from Pickering with a question. Hi there, Ray.
Oh, hello to you both. Happy New Year. I've been preparing for my tax-free savings account for the last month or two, and I've been watching Fairfax Financial, and I wanted to purchase it, but now it's kind of popped in the last month, so I don't know if you think it's a little overvalued or if you maybe could recommend something else. And possibly, Lindsay, if you could find analyst price targets for the stock, that would be helpful as well.
Okay, I'll do that while you start answering that question, Dan.
Well, Happy New Year, neighbor. I'm in the same city as you. So first and foremost, when you think about Fairfax, the reason the stock has done as well as it has from in the past is basically they were on the right side of the interest rate trade and their underwriting operations improved. And what I mean by that is back in the day, Fairfax's combined ratios, as they're known on the insurance side, were a little bit choppy and volatile. They've really improved on those. The next step is they actually didn't get hit on the insurance side, the interest rate side, as rates rose, because their portfolio was very short duration bonds, as it's known. So that's check, and then it comes down to where we stand today. Do I think it's a screaming buy opportunity today? I don't, and that's primarily a function of the easy money in Fairfax has been made over the last 2 years. And now you're basically paying a fair price for a fair asset in the context of the Canadian market. I would much rather buy Intact on the dips than I would a Fairfax, but I think Fairfax is attractive and we also own it in our Canadian portfolios.
And just to answer that as well, the last analyst recommendation was on December 15th by RBC Capital. It's an outperform, same with outperform by Raymond James, but that was on November 24th, so nothing new in the last couple of weeks. Okay, we're going to take a quick break right now. We'll be back with Dan Rohinton of IA Global Asset Management, taking your questions on Canadian and global large caps. That's coming up right after the break. Stay with us. Welcome back to Market Call. Dan Rohinton joining us today, answering your questions. We're going to go straight to the phone lines once again. Chris from Delta, BC is calling in with a question. Hi, Chris.
Oh, hi, Lindsay. Hello, Dan. Thank you so much for taking my call. Dan, I've asked you before on CN Rail, and you highlighted Union Pacific as sort of a, maybe not a complete alternative, but a complementary position if you already had a big position in CN. I'm just wondering, CN is still hasn't participated in any sort of rally in any segment of the market. And I'm wondering if you still see it as attractive for a long-term hold, if you would still see it as sort of the best buy at this point. I will hang up and listen. Thank you both, and Happy New Year.
Thanks, Chris. Happy New Year.
Happy New Year, Chris. So the best way to think about, and I will dig into Union Pacific as well. So the reason CN and the rest of the rails haven't done what you would expect and call it a broad speaking bull market is that it's been a very bifurcated bull market. So if you were looking at the industrial economy, you're still looking at a modest recession and everyone's waiting for the goods economy to come back. So the real growth and the gains in the stock market have come from the technology stocks and the really high growth, higher risk, more cyclical companies out there. CN Rail, UNP, and most of the other rail companies really focus on moving more carloads, and that part has been missing. So do I think it's an attractive Canadian equity? I do. And I just want to double click, Chris, on your point about what I said last time, because I think it's just as important today. Union Pacific, I think, is a more attractive rail if you didn't care about just being in the Canadian sandbox and you were okay with looking around more globally and especially North America. The reason Union Pacific, I think, is more interesting is what they're doing with their purchase of Norfolk Southern. They're merging into what's known as a transcontinental railroad. And that's critical because when you're in Mississippi, you have one rail track that then goes to another rail track owned by a very different company. And that adds days of delay on a single carload, and that's why trucking has been so successful and so resilient, despite moving call it an intermodal container, those big shipping containers you see. It's 1/10 the cost to move it over a railroad than it is by truck. But now, if you have a transcontinental railroad, you can connect to any point across three different parts of the three different basically oceans in America, and push it all with the most synergies together. So I think UNP is the most attractive, but if you want to be in Canada, I think the rails are reasonable positions as well. I just think it's just a question of, do you want to own a company that has a bit more under its own control and has significantly more upside if the rail merger goes through. And I still think that's UNP.
Okay, good point. Elliot now calling in from Hamilton with a question. Hi, Elliot.
Good afternoon. I'm looking for global industrial exposure. Steady Eddie, I think, would be Mettler Toledo International, the scale company. How do you see its growth prospects? It's still down 10% from its high. Your comments, please.
Okay, thanks, Elliot.
Yeah, so it's not just scales, it's precision scales to a degree that we haven't really seen with most other companies. So this is...
What does that mean?
Precision scales being, it basically can do microscopic type of measurements.
Okay.
So this isn't your, like it's not a usual industrial scale. It's truly for very specialized tasks. So that means returns are extremely high for Mettler Toledo. I think their returns on invested capital are north of 30%. That's incredible for an industrial. Their growth rates are reasonably consistent. The problem, I think, with Mettler just ends up being, what do you pay for it? And they don't tend to benefit overly too much with what's going on trend right now. So I don't think they're the biggest AI beneficiary, if memory serves correctly. So I would just say, do I think it's a quality industrial company, extremely well managed? I do. I think the valuation has been consistently rich. I just don't think there's a reason to overly pay up for it when there's all these other high quality growth opportunities in the market today. So I love it as a long-term company. I love it as a long-term business. I don't know if I love it as a long-term stock from the valuation levels we are today.
Okay, good to know. Now we're going to go back to the phone lines. Peter's calling in from London with a question. Hi, Peter.
Hi there. Hi, Lindsay. Hi, Dan. Happy New Year to you both. Ever since cocoa prices spiked, Mondelez International has been going down. And I'm wondering if there's any other issues involved with that company. Should I stay with it, or should I just sell out and go to better pastures? Thank you very much. Bye.
Thanks, Peter. Yeah, it has been, I mean, look at that since August, going down a bit.
So what is Mondelez? It's a lot of things. It's got a salty section. It's got confectionery, so chocolates and things like that. The reason the stock's been weak for the last 2 years has been twofold. The first one is the hangovers that come from COVID. So the pantry stuffing days are over. So the second piece of it is, the more important one, is that cocoa prices have gone absolutely through the roof. And the reason for that has been what's known as swollen shoot disease in West Africa. And a cocoa crop you don't just plant it in the spring and it matures in the fall. It takes actually years for it to give you enough of a yield. And that's been the reason why all of these companies have been struggling with basically input costs that are going through the roof. And they can't really find a lot of substitutes for it. So you can get nougat and things like that, but consumers just like chocolate. And the demand for chocolate that is more pure, 80%, 90% cocoa, things like that, keeps the demand high. And at the same time as you have a supply pinch. So I would just say, when you own Mondelez today and for the foreseeable future, you're basically making a bet that cocoa prices fall, because Mondelez can't push prices higher on their consumers, because we're going to go switch from dark chocolate to milk chocolate to sour keys or something like that. So that's the key here, is price substitution we're at that level, and that's where it's demand destructive. And the supply side from the cocoa crop, there's only so much they can do. So they're a prisoner to bad weather in West Africa, and there's not much they can do about it. Do I think it's a reasonable entry price today if you want to take a 5-year optimistic view? I think that's reasonable. But you have to understand what you're signing up for, which is basically for blue skies in Ghana.
Interesting. All right. Sam now calling in from New York State with a question. Hi, Sam. What's your question?
Hi there. For taking my call. I really appreciate the answers you're providing. The people calling, you're extremely thorough.
Thank you.
And I think everyone appreciates that. My question's on the TD Bank. It's had a good run, but its PE is still relatively low at 11 compared to the other Canadian banks. And so do you think there's still more upside to go? Thank you.
Okay, thanks very much.
Yeah, so it's been a phenomenal run. Congratulations. I would say where we take a step back from today is it as attractive as it was at $70, $80? I don't think so. And I think 11 might be a little bit low if memory serves correctly. It's probably closer to 14, which for a bank, especially in the Canadian market, tends to be on the upper end. So I believe TD and most of the other banks are effectively at all-time high valuations. And I mean going back to the 90s on pretty reasonable fundamentals. So what I mean by that is they've got basically optimized income statements, they've got reasonably optimized capital. So there's a little bit of juice there, but that's really all you're playing for at the margin here. So if you wanted to diversify a bit out of the banks, I wouldn't stop you. Do I think TD is unique in that conversation? I don't. I think TD is just one of the 6 that is effectively trading at 25-year high valuations. And TD specifically was a little bit weak for a while because they were going through the anti-money laundering issues where they got caught off guard in the United States. That seems to be pretty benign. So now it's just a question of valuation and what's the growth look like from here. And it's important when you think about Canada, and I want to ramble a bit on this point because I do think it's important. You have to believe that the Canadian consumer is going to be okay, and you have to believe the Canadian home prices are going to be okay. And I think that's critical to understand because the majority of the loan books in the Canadian banks are consumer related in the Canadian division, and Canada is extremely profitable for these companies.
And you are correct. The last all-time high for TD Bank was on December 30th, so just a couple days ago. Yeah. Okay, we're going to take a quick break right now. When we return, though, we will take a look at some of Dan's past picks. That's next. Stay with us. Welcome back. Dan Rohinton joining us in studio today on Market Call. We're going to go through some of Dan's past picks now. These are from January 3rd, 2025, so basically a year ago. Your first one, Dan, is United Health, recommended at $513. It's now sitting at $332.68. Are you still holding this one?
We are. We actually ended up buying more. So I'll give a bit of background on what actually happened. So what happens with insurance companies, and this is quite possibly the worst one we've seen.
That's a chart.
Yeah, that's quite a chart, right? So what ended up happening with United Health was their underwriting operations got caught offside because medical demand far outstripped what they had estimated. So they thought procedures would be up 3, 4, 5%. They actually ended up being significantly higher than that. And despite what you hear about the healthcare insurance sector in the U.S., the margins are razor thin. So United Health's margins are 2, 3%. So if you misprice by a few percent, you actually can get caught offside. We think this is an interesting opportunity. This is unfortunately one of those examples where we bought at the highs and we bought at the low. So we actually took some profits around the 370 level, but I'm comfortable owning it today, and we still own it as a significant weight in the portfolio. And I would make it a future pick along with a past pick.
You think you're going to see a bump in this year in 2026?
Yeah. And maybe I'll just double click on that a little bit. The reason why I think it's important to give insurance companies time to fully see something through is you can get the expectations wrong in 1 year. It's hard to get it wrong for 2, 3, 4 years. So they've actually increased their estimates for costs, and they've pushed that onto the consumer because at the end of the day, when it comes to insurance, the consumer pays. The insurance company is just pooling it together. So I think those assumptions are critical, and I think this year will be far better for this company.
All right, next past pick is Waste Connections, recommended at $170.93. Now sitting at $174.73. 2% return, total return 3%.
Yeah, pretty forgettable. But at the same time, what's going on with Waste Connections is it's fallen actually out of love just because everyone's infatuated with high-tech, high-growth AI stocks. So when you're collecting garbage on a day-to-day basis and doing it well, it's easy to forget this type of company. Same with United Health, and actually for all of our future picks too. We own them in the portfolio. We have for years. I think it's a great company. It's well managed, and you should average into it.
Speaking of high-tech stocks, that's kind of your last one. Microsoft is your last past pick when you recommended it $423. Now it's up more than $476, and it's probably going to continue to go up, I'm assuming, in 2026, given what we're seeing.
Yeah, and I actually think it's getting cheap, and objectively so. The only reason I didn't make it a forward pick was we can't, for the rules, we can't do past picks or forward picks. But when we're talking about what Microsoft is going through today, it's actually derating. So the problem with Microsoft is they can't get enough chips in their data centers powered up fast enough for the demand that they need to service. So I actually think Microsoft, because the AI labs have been getting so much attention, has been left behind a little bit, even though when you think about how AI is going to be diffused as it's known to the world, it's going to come through what's known as the big clouds. And Microsoft, along with Amazon Web Services, along with Google Cloud, are the distribution platforms to distill AI into our day-to-day lives. So I'm extremely bullish on Microsoft. It remains a significant weight in the portfolio, and I think it's going to have a great year.
Okay, we're going to take another quick break right now, but we will be back with Dan Rohinton of IA Global Asset Management, taking your questions on Canadian and global large caps, and we'll be back right after this. Stay with us. Welcome back to Market Call. Dan Rohinton joining us in studio today to answer more of your questions, and we're going to go straight to the phone lines. Sam is calling in from Montreal with a question. Hi, Sam.
Yes.
Hi. What's your question?
Okay. This is regarding Atkins Realis. Okay. What's your take?
Okay, thank you. What do you think about Atkins Realis?
So the formerly known as SNC-Lavalin
Yes.
for the folks paying attention. So a good rebranding, and the stock's done pretty well. So when you think about what Atkins has turned into, there's a few things to really take stock of where we are today. It's effectively a nuclear proxy stock, and so you can own Cameco directly for Cigar Lake exposure and so on and so forth, or you can own Atkins, which basically helps build out, I think about 35% of their entire engineering backlog is nuclear related, and nuclear has really come into its own. So do I think it's an interesting company from where its end exposures are? I do. Do I think it's the best managed engineering and construction firm in Canada? I don't. I would actually give that title to WSP, which actually just did a pretty attractive transaction pretty recently. So if I had to choose between engineering firms, I don't think this is the best one. And I think you're better off owning your nuclear AI exposure directly through NVIDIA, directly through Microsoft, or directly through Cameco. You don't need to do it by proxy here. But if you think engineering is why you are interested, then look to WSP. It's well managed, and they just did a great deal.
Okay, good to know. John is now calling in from London with a question. Hi, John.
Hello, Dan. Our youngest just turned 18. Speaking of tabula rasa, he bought his first two stocks, Google and Broadcom, and so far he's done really well, I have to admit. I'm trying to steer him towards something a little more stable, maybe GE Aerospace, Honeywell, maybe even Energy Fuels. I wonder if you could recommend a sector for my son and maybe a stock or two. Thanks very much.
Thank you. Thanks for the question. So something more stable is what John's saying, a stock or a sector. Do you have anything in mind?
I'd actually disagree. I think you should let your son go. You know, it's good for him. This is phenomenal. So when you think about just taking a step back, when you think about someone who's your son who's 18, he's got a lot of years ahead of him. So having a very high risk tolerance. I'm not an advisor, but just
we have the disclaimer.
We have the disclaimer. Yeah. Okay, perfect. So he's young. He's got lots of time, and investing in high volatile companies like Broadcom can be, as we move further down the AI cycle. I think that's acceptable as long as he's okay with the risk and you're okay with the risk. So I like GE Aerospace. I think it's well managed. I think Honeywell is a bit more of a neutral conversation, but it's its own turnaround coming through. But I think for his risk profile, for his age, and for what his interests are, let him run. Google's a great company. They're a leader in AI. They're moving further down the stack. And TPUs, which is why he probably owns Broadcom as well. The chips that Google makes is actually made by Broadcom. So Broadcom is the shadow NVIDIA of it all. And that's a question of valuation. I think it's an attractive company. We've owned it for years. We still do in a far smaller way, but that's a valuation discussion. So let him run with the sector. It seems like he's having fun. He's having a good time, and let him stay invested.
Okay, and 2026 is going to be interesting when it comes to the battle for chip makers, right? So we'll have to see how that goes, but that's good to know. Thanks so much. Jack is now calling in from Toronto with a question. Hi, Jack. What's your question?
Yes, good afternoon to you, and and all the best. Ask the gentleman about CNQ. Is it to hold or to sell? I know it's a great company, and the OPEC will come to their senses to lower the production. However, thank you very much. And also, if he has it in his portfolio. Thank you very much, and have a happy New Year.
Okay, thanks, Jack. Happy New Year. CNQ, buy, sell, what do you think?
We own it in the portfolio. I think it's an attractive opportunity today. But I think just taking a step back. So as Jack was saying, it is very well managed. Mm-hmm. It's got a great management team. It's got a good asset footprint. They've got enough takeaway capacity now. So all of that is well and good. The question on OPEC, I'll actually take the other direction on. So the idea that OPEC coming to its senses, I think we need to take a separate paradigm. And I've actually changed my mind on this in the past few months. I think we're moving closer and closer to a post-oil society. And I think that's generally speaking a good thing for most of the world. It's not a good thing for Canada because a lot of our prosperity comes from the dinosaur juice that sits in Alberta that's sent to the rest of the world to burn.
And we want to ramp it up.
And we want to ramp it up, and we should before we move to a fully post-oil society. And what I mean about that is OPEC is basically oversupplying the market, but I think it's important to take the other side of that discussion. There's a hot war in Russia with Ukraine. There's tankers being shot down or basically sunk carrying oil in it. there's an embargo on Venezuelan oil, and there's been Iranian oil has been curtailed to the tune of several million barrels a day. So as much as OPEC is over producing, there's a lot of other parts of the world where there's been significant supply shocks, and oil is still $60 below a barrel. So that tells you that the pinch point, the old Hubbard's Peak, the Jeff Ubben, we need to all live in smaller societies because there's not going to be enough oil to go around, I think is completely the opposite of the world we live in today. The question as Canadians we have to ask is, we have to deal with this for the foreseeable future, and what we have to ask ourselves as CNQ investors is, are their cash costs and their returns going to be sustainable enough in the current oil paradigm? I think that's the case for them because I think they have the discipline, and that's why we own the stock. But I'm not overly bullish on oil.
Okay, very interesting answer. We're going to move on now to another caller. Lawrence is calling in from London with a question. Hi, Lawrence.
Good afternoon. Thank you for your past suggestions. I've had Royal Bank for a long time. Should I buy more of it?
Okay, thanks so much. Royal Bank, do you like this one?
I do, but I don't think you should buy more of it.
Why is that?
Same thing as TD, honestly. It's tomato.
Right.
25-year highs in valuation, extremely well managed, extremely well run, and that's all great. But when you trade at basically peak valuation and you've got effectively peak earnings expectations built in, and let me unpack that point a little bit. They've released the reserves just for the most part, so there's not too much juice there. Their capital is mostly optimized. So then what are you incrementally getting from here? You're basically earning your dividend yield plus a little bit of EPS compounding. So could this get you to 5, 7, 8% return on a forward-looking basis over several years? I think that's reasonable, but that's kind of the optimistic scenario. So I think the Canadian banks as a whole, we own far less of them than we used to, because the question really comes down to is, are they baking in too many positive scenarios? And I'll reiterate my sermon on TD Bank that I will for Royal. Royal's more diversified than TD and more so than CIBC or any of the others, but you cannot outrun the Canadian consumer when it comes to the Canadian banks because it is the majority of their loan book. So you have to be optimistic on basically GTA home prices and Vancouver home prices and Calgary home prices for you to be wildly optimistic on the Canadian banks.
Are you optimistic on these home prices in the new year?
No.
Okay, we'll leave it there. We have to take another quick break. We will be back with Dan Rohinton of IA Global Asset Management, taking your questions on Canadian and global large caps. Right after this, stay with us. Welcome back to Market Call. Dan Rohinton joining us in the studio. Going straight back to the phone lines. John is calling in from Burlington with a question. Hi, John. Hello? Okay, I think we might have lost John. We'll move on to our next caller in the meantime. Hopefully John can get back on the line. Alan is calling in from Toronto with a question. Hi, Alan.
Hello. Questions on Costco. Has not been performing very well lately. Would you get in, and at what price? Thank you.
Okay, thank you. What do you think about Costco?
So the reason Costco has been a little bit weaker has been twofold. So just like with Waste Connections, you know, no one cares about garbage, but no one cares about buying tissue paper by the pallet. But that being said, Costco is extremely well managed. It's well run. It's got a long runway of unit growth. The problem is valuation. The problem with Costco for a long time is, do you want to pay 50 times earnings for this company that you know is going to grow 10% per year? So I think we're not quite there yet, but I think if there's another 10% pullback or so, I would definitely be interested. The reason for that, just to understand why you want to own Costco as a 10-year investment, is that they're extremely durable, and rain or shine, they take more market share because it's a lot cheaper of a value proposition to pay $50, $70, $80 annually for one membership card and then get everything at cost plus 3%, or sorry, cost plus 5, 6%, which is what everything at Costco is. The reason everything is so cheap there is because they just mark up a very small amount relative to other retailers. So consistent share gainer in general merchandise, rain or shine. The problem is valuation. It was peaking at 50 times, which is too high for this company, but somewhere in the 30s, we're interested. And I think if you get to around 750, 770, I'm definitely a buyer.
Okay, next caller is Ryan calling in also from Toronto with a question. Hi, Ryan.
Hey, Happy New Year, and thanks for taking my call. Dan, thanks for always being a wealth of information. Always really appreciate your insights. My question today is on Oracle. It's obviously been quite volatile as of late, but I think there's definitely room for another winner in the cloud space. What are your thoughts on Oracle for a long-term hold, and do you own it?
Okay, thanks, Ryan. What are your thoughts on Oracle?
We do own it in the portfolio. Okay. This is definitely the most YOLO of the hyperscalers, if you will. YOLO being you only live once. The reason I say that is it's not very often that someone who's worth $200 billion decides to bet the company on basically turning himself from a 200 billionaire to a 400 billionaire, and that is what Larry Ellison did. The story behind Oracle over the last year has been they effectively did a partnership with OpenAI when Microsoft got a little gun shy about how many billions of dollars or tens of billions of dollars that ChatGPT was asking Microsoft to spend. Oracle said, no problem, we'll build you a 4.5 gigawatt mega campus in the middle of rural Texas to basically do all of your training runs from now until 2030. The first of what's known as the Abilene Stargate supercluster is actually already coming online, and that should drive Oracle's earnings basically to double from where they are ending 2025 to closer to $20 by 2030. The reason why you have to take a step back and why it's not a top pick in the portfolio coming up is it's going to take a lot of debt. The margins aren't the highest because training AI model is not as attractive as Microsoft inferencing out that AI knowledge to you and I, to hundreds of millions of customers around the world. So it's less profitable, albeit still quite good. And then the question is, once that's built out, can Oracle then expand to the enterprise and take their natural database share that they had in the on-premise world before cloud really took over? I think all of that is far more likely to happen than not, but you have to understand what you're signing up for, which is the most YOLO of the cloud AI stocks in the large cap space. So modesty and diversification is important and cannot be emphasized enough for this company.
Okay, Satinder now calling in from Regina with a question. Hi, Satinder, what's your question?
Thank you for taking my call and Happy New Year's. Dan, could you comment on Capital Powers? Thank you.
Okay, thank you. Capital Powers, what do you think about this company?
So this company is basically, once again, an AI discussion by a slightly different vein. Mm-hmm. Capital Power has natural gas plants in the United States, and they own basically some of the merchant assets that sit in Alberta as well. The reason why Capital Power has done really well recently is that the demand for power has shot through the roof, and so everyone's trying to scramble to get some. So their assets have been revalued significantly higher. It's actually very well managed. They're one of the few companies that have a surplus of power, especially in Alberta. I think it's Genesis 1 and Genesis 2 are the big combined cycle plants that they have in Alberta. The whole game theory is, do you think the province is going to allow that capacity to be released, or is it going to take too long? I think that the chances of that really happening this year are probably a bit low in the Alberta side, but they also have the opportunity to buy and scale up and basically reconvert old coal plants into natural gas plants in the U.S. in the PJM district, power district. So I think Capital Power is interesting. I'd be a buyer today. But once again, when you come to AI stocks and AI proxy stocks, Oracle's your supercharged hot Ferrari that can crash on you if you go too fast. This is your derivative of that. I would much rather play AI through the Microsofts of the world and maybe a little bit of Oracle than Capital Power. But if you're focused on Canada, I think it's okay to own it.
Okay, we're going to go to an email question now. This one coming in from Mike, and it reads, I would like to ask your guest about Arista Networks. Is it a buy? Arista Networks. You think this one's a buy?
So it's another AI stock, and very much so. So the AI Arista Networks is, as the name would suggest, a networking company, and the largest driver of their growth has been specifically Meta Platforms in their build out of some of their bigger clusters. I think it's called Hyperion's the most recent one, and Arista basically has the highest throughput networking cables that are out there. And I don't have a strong opinion here. I think it's probably okay, but you have to ask yourself, do you think networking is going to be the structural bottleneck from here? There's a chance that's the case, but you're better off probably served just owning NVIDIA, which is at a lower valuation than Arista, or an Avago, which has, largely speaking, the same growth prospects, but with more diversification. So do I think Arista is part of the AI basket and will participate? I do. And I just think that there's a better, more diversified way to do it, and that's probably NVIDIA.
Okay, we're going to take a quick break right now, but when we come back, we will take a look at some of Dan's new top picks. That's coming up right after the break. Stay with us. Join us Monday on Market Call. Rick Rule will be on the show. He is president and CEO of Rule Investment Media, LLC, and will be taking your questions on natural resource stocks. And if you missed Market Call today, you can always check out our daily podcast. You can find it on iHeartRadio and other platforms, and you can also watch full episodes on our YouTube channel. And Dan Rohinton joining us in the studio today. We're going to take a look now at Dan's top picks for this year. So Dan, we'll start things off with Visa. I think most people know this company. What do you like about the stock?
So once again, when we're seeing a world where the market is broadening out and should broaden out as we look ahead, there's few companies that trade at discounts to their long-term averages that have the same, if not faster growth than in the past. So Visa is one of those companies that definitely fits the bill for us. We've owned it for years too, but I'm more interested today in buying into the valuation where it sits today, because when you think about agentic commerce, so what does AI mean in our day-to-day lives? It means less use of cash to basically zero. We're mostly there, but there's still a little bit more to go. And also the velocity of payments picking up. So if you go and say, I want to book a trip to Europe and I want to eat at these restaurants, an agent that can do it for you, they're going to be clearing all those payments through Visa. So faster payments velocity, that same entrenched dominant position they've had for 25 years, at the same time as its valuation below average, sounds good to me.
Okay, your next one is Amazon. You say Amazon kind of lagged the market in 2025, which is maybe good news heading into the new year?
Yeah, and it's basically, I couldn't put Microsoft, so I put Amazon, because I think both are pretty interesting.
Right.
And the reason Amazon is interesting, along with Microsoft, along with that, maybe less so Google on valuation today, but the Amazon and Microsoft, specifically for Amazon, the retail business is wildly profitable now in the United States and Canada. It's less so in international. But what you're really seeing and playing for is Amazon Web Services, the big cloud computing giant that it is, basically participating more in the AI distillation and disbursement around our society, because all of the tech companies and the cloud companies, so the Netflixes of the world, the Spotifys of the world, they all started on Amazon Web Services, and look how big they are. The new AI-related companies are also going to be hosted on Amazon in different capacities, and they are once again going to keep accelerating the growth rate. So durable growth, very low valuation relative to its history, and profitability that's improving across divisions, even through a massive investment cycle. Once again, looks good to me.
You weren't allowed to pick Microsoft again as a top pick, but between Amazon and Microsoft, is there one you prefer over the other, or are they both kind of doing?
They're actually pretty close to each other, but I'd say Microsoft at the margin, just because Microsoft is more obviously bottlenecked in its ability to deliver. So for them, the demand is there. With Amazon, you're almost certain the demand's there, but with Microsoft, it's basically a guarantee. Right. So Microsoft by a hair, but I like both, and we own them both across our portfolios in significant ways.
Okay, last top pick is Linde.
Linde.
Linde, okay.
Yep.
Linde, tell us about this one.
So industrial gas. This is once again a quality company that's been a little bit forgotten because it's not AI related. And what it is it's industrial gases. So when you own an industrial, call it a smelter or a steel mill or a fabrication facility for semiconductors, you basically contract with Linde or its peer Air Products or Air Liquide, which is the third player in the oligopoly, to basically have very pure oxygen, nitrogen, so on and so forth, those specialized gases for those very specialized industrial processes. And then the beauty of the business is that anchors the investment. But then if you look around 200 miles, you can actually sell that in the merchant market. So if you're a hospital that needs specialized oxygen, you go to a Linde through the healthcare division, and that actually comes from potentially a steel mill. So the gas can go everywhere, and the steel mill or the data center anchors the actual investment itself. And I think it's trading at a pretty reasonably low valuation for a long-term investment. We've been owners for a while, and I think it's an opportunity to buy more today.
Just before we wrap up here, because we have a little time, you like the AI sector and some of the tech stocks, especially like Microsoft, Amazon, the ones that are kind of dispersing all this AI technology. Is there any other sectors as we head into 2026 that you think are going to kind of boost up a bit from 2025?
Yeah, I think, and I'd caveat my comment is a lot of the conversation we've had has been in durable, high quality, mid to large cap companies. A lot of the true, so in some ways, I'm not pessimistic at all. I'm actually optimistic on where AI is going in the future. But I actually find myself in this odd position where the rip-roaring expectations in the private markets make me seem downright conservative, despite me being optimistic. So I think technology is interesting, but nowhere near what some of the bullish forecasts you see elsewhere. I think taking a step back, more of a dark horse sector, healthcare has been left in the lurch quite a bit last year and the year before. I think that's going to be interesting because some of the worst fears around healthcare, like we said, claims inflation, at the same time as we're seeing the pharmaceutical companies being battered once again by the U.S. administration on drug prices. I think we're starting to clear that a little bit more now too. So I think this year will be more diversified, and I think healthcare is just going to be a part of it. And I don't think technology is going to have a bad year, but boy, has it had a few good years so far.
Yeah. Okay, Dan, that's all the time we have. Thanks so much for coming in. Appreciate it. Happy New Year to you.
Happy New Year.
And we'll see you again soon. And thanks for watching Market Call. We will see you next time.